and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, U.S. stock futures pointing to gains at the end of one of the most intensely volatile weeks in decades. Investors grappling with the fallout from the global trade war. Now, President Donald Trump has acknowledged his tariffs may cause transition problems, but has expressed confidence in his plan. Now, that's after the White House clarified that U.S. tariffs on China have now risen to 145%. Trump says he would like to make a deal with Beijing.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
Meanwhile, the Spanish Prime Minister Pedro Sanchez has met with China's Xi Jinping in Beijing, where he stressed that the trade war, of course, does not have to get in the way of retaliation between the EU and China. Now, for more, let's bring in Ross Matheson, Bloomberg EMEA News Director, and Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Ross, in the last couple of minutes, China has announced tariffs on the U.S. This feels like actually quite a significant escalation. China will increase tariffs on U.S. goods to 125%, and it's announced these additional tariffs on U.S. goods. I mean, we thought that China was a bit in a wait-and-see situation. It feels like they're going large.
Well, certainly they are. As you say, we just got news a few minutes ago that China is retaliating again against the U.S. retaliation, so it's hard to tell who's retaliating in what way at this point. But China's now saying they're at 125%, and Donald Trump saying that U.S. tariffs are on China at 145%. So we're in the realm of just endless tit-for-tat, it seems, at this point. But the message very much from China is we are going to escalate if you're going to escalate. Whether that creates the room that Donald Trump is talking about for conversation at some point, it probably still does, because Xi Jinping and Donald Trump are both pragmatic enough to know that they probably should talk to each other if there is that opportunity. But how do you get agreement and understandings to talk in a climate like this? But certainly China sending the message again that they're not going to start to slow down in the face of Donald Trump's escalations on trade.
Yeah, and Christian, I guess this is, what everyone was waiting for. Does China kind of stand still and try to negotiate, or do they ratchet it up? Is this just going to escalate, or will there be common minds at some point?
Yeah, I think the uncomfortable thing for markets right now is this escalate to de-escalate idea. I mean, you've seen that to some extent with the reciprocal tariffs and the 90-day pause. Like, you had an escalation, and eventually there was a pivot. And the market has the same to some extent with the US and China. Where does it get worse enough? And the market never likes things it can extrapolate, and it never likes things that cause uncertainty. So the more you escalate, the more you cause uncertainty. So I think in summary, as of now, it seems like negotiations, escalations, and the market will price this increased uncertainty until you have to pivot.
Yeah. Who blinks first, Ross, I guess is the question, right? And is this just geopolitics, or is this about the economy? Yesterday, we also know that China really took quite a lot of time to try and figure out whether they could support the economy to a point where they felt comfortable, with an escalation.
Well, Xi Jinping probably feels fairly comfortable. I mean, they've done quite a lot of work in China to diversify their economy away from the US. You can see that in the way that the trade has risen with other places and the kinds of goods that they're shipping to the US versus what they're importing from the US. So they can possibly weather it a bit better in terms of the direct impact on consumers. For the US, it's much more direct hit on consumers. Xi Jinping is also doing a lot to try and boost consumption in China. We're expecting more from that, possibly even today, more announcements on stimulus from China designed to juice their own economy. But equally, they do have their own bases to think about here. Xi Jinping needs to look strong for his domestic base. Donald Trump needs to look strong that he's standing up to his own voters. So when you've got two leaders who both need to play to their bases, both need to look strong, how do you thread the needle through that to get to the point that you can talk to each other without looking like you blinked first? And so that's the difficulty. How do you navigate through this? They probably do want to talk to each other, but they can't be seen to be backing down.
I was going to say, what's the likelihood of the two leaders actually meeting?
Well, very unlikely they'll meet in person in the near term. Interestingly, we saw news today that Xi Jinping is inviting EU leaders to come to Beijing again, and that's a fairly regular thing, but the last visit was also to Beijing, so he wants to host them in Beijing. This is the Brussels leadership. We saw that news coming out this morning, so he's certainly making sure that he's keeping all his options open. A sit-down meeting, that's a really difficult thing to arrange. Even a phone call seems quite difficult at this point, but you'd have to start with phone calls and build up to a level of understanding to have a sit-down meeting.
Christian, when you look at, again, the market volatility has frankly been crazy this week. Yeah. I know Goldman also changed your call on a recession. With tariffs going up from the China side, is a recession in the U.S. even more likely?
Yeah, I mean, any tariff and any uncertainty is not good for growth and increases the risk of a recession. And I think the financial conditions tightening is really the most important thing to watch right now, because what you've seen yesterday is the equity market selling off together with the treasury market.
Right.
And that, to some extent, is a tightening of financial conditions, which shows us that's going to cost growth. And these financial condition shocks, according to our economists, go into growth very, very quickly. So in that regard, I think the kind of high-frequency indicator for recession risk is the market, and the financial conditions are tightening, so recession risk is going up.
Okay, Christian, let's listen to the president actually talk on Europe, and then we'll get back to see how you play European equities right now. Here's the president.
They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China. And they said, we're going to hold back a little bit. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States.
I mean, it feels like, the President of the United States is saying that Europeans capitulated, which is not at the moment what happened, Roz.
Well, the EU's been walking the steps and doing that quite carefully, but always knowing and making clear that they've got stuff in the arsenal. But also, under their rules, there are only certain things they can do across a complicated time frame. They're actually bound not to be loading tariffs on the back of each other. That's just part of their own rules, and so they are abiding by that. But equally, seeing that the pause did come, it makes sense for the EU to say, OK, we will hold off ourselves on that. But they are making clear that they've got all these things in place. They can enact them pretty quickly if needed, but obviously wanting to leave room for negotiation. I mean, Donald Trump keeps saying he wants to talk to all these countries. He personally wants to be involved in these conversations. And there's a lot of talk about 70, 80, 90 countries all lining up to talk to us, and we're going to get deals. Those will obviously take time, so it makes sense for the EU to play its cards carefully.
So, Christian, when you look around the world, how do you build the perfect portfolio? Or a portfolio?
Yeah, I mean, listen, I think one thing you clearly have learned this year is that international diversification is getting much more important. Yeah. Kind of FX overlays will get much more important, major regime shift for the dollar. So I think you want to think about diversification across and within assets much more than you have in the last 3-4 years, but the last 15 years, where the US assets, equities, the dollar, they've completely dominated in terms of size in your portfolio. So that is a major rethink. And then the other thing is obviously about safety. What is safe if the treasuries aren't, if the dollar isn't? And so we discuss a lot the Swiss franc, we discuss the yen, and obviously gold. That's the kind of crude instrument. If nothing works, you go back to gold. It has a few hundred, if not thousands, years of history, which you can't argue with.
What do you think happened with treasuries this week?
Listen, I think it's very difficult to say because there's multiple things at play here. I think, first of all, you have, from a market microstructure perspective, from a liquidity perspective, a lot of concerns about the owners of treasuries and who's currently selling. Then you have a fiscal deficit of 6% and the prospect of a US recession. That's very seldom that you have such a large fiscal deficit going into a US recession. Then you have a lot of concern about, the long-term outlook for debt anyhow, globally. So I think put it all together, I think the treasuries will not be buffering equities as we like. But really important to keep in mind, bonds are not that risky. So the fact that the bond yields are going up a bit means that you might lose 1% or 2%, whereas in equities you can lose 1% or 2% literally every hour. So from that perspective, we are still advocating that you want to have a bond allocation. I think the bond allocation might have to be diversified internationally. You might want to be a bit shorter duration, but it doesn't change the fact that bonds are a core part of a risk-off portfolio.
Christian, yesterday I also spoke to Ray Dalio about the reliability of the U.S. longer term, and this is what he had to say.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
So, Christian, do you see this as a medium to longer term problem, or could it be, coming to bite the U.S. sooner?
I think the market is currently looking both at the cyclical risk, as you mentioned, the recession risk, but there is some structural risks as well. So the US and President Trump wants to get manufacturing back into the country. And the problem is that the equity market is not very exposed to that. The equity market is in large cap tech, capital-light business models that are very profitable. And if you now see some of the policies that make the American manufacturing come back hurt these profitable companies. And what we actually showed is that the U.S. equity valuation exceptionalism, like both relative to its own history and the rest of the world, can be explained by only two variables: low and anchored inflation in the last 20, 30 years, and rising and high corporate profitability. So if the tariffs are threatening that equilibrium, the market needs to rethink to some extent the longer-term equilibrium for equity valuations in the U.S. And that's more structural.
And I guess on the structural longer-term implications, Roz, I mean, I know there's a lot of chatter on what the U.S. would do if Taiwan were to be invaded. I mean, many question marks, but is there really a geopolitical vacuum that China could fill, actually, in all of these kind of uncertain times?
Well, there's a lot of countries trying to fill vacuums at the moment. So you're seeing a very interesting recalibration of relationships around the world. And what that settles in, we really don't know. But it does seem that, a lot of countries are saying long-term reliability question for the US. As a partner here, whether you're an ally or whatever, that's changing. And so that's a deep structural change that washes out in ways that we just can't see at the moment. But we do know, for example, the EU's talking to the UAE about different kinds of trade and other understandings. These relationships are moving and shifting now quite quickly, and the role of China in that, again, with the Spanish leader in China today talking up a balanced relationship with the Europe and China. That's a very different kind of conversation. I mean, he doesn't represent all the views of Europe in that. There are some concerns about going too quickly towards China again in Europe, but it's interesting those conversations are happening. And so whether, it's only been a few months of the Trump administration, it might feel forever. It's only been a few months. We've got years of this yet, potentially, to go, and then whatever comes after the Trump administration. And so we're in a much longer-term recalibration of global relationships, and that's going to have a lot of knock-on effects.
I feel like the last 5 trading days were forever. Roz, thank you so much. Roz Matheson, Christian Mueller-Glissman from Goldman Sachs stays with us. We'll talk a little bit more about European equities. Now, coming up, Prada buys Versace for nearly $1.4 billion. We get the latest on the luxury deal and the market reaction. That's next, and this is Bloomberg.
With investors on edge as tariff headlines spark volatility across global markets, Bloomberg Surveillance has the insight and commentary to give you a jump start on the trading week. Tune in for special coverage this Sunday starting at 6 p.m. Eastern. Context changes everything.
The conversations that matter, the insights you need. This is the Pulse, and I'm Francine Lacqua here in London. Now, Prada has agreed to buy Versace for nearly $1.4 billion in cash, strengthening its position as Italy's largest fashion group. Now, to discuss Prada's largest ever purchase, we're joined by Bloomberg opinion columnist Andrea Felstead with Goldman's Christian Mueller-Glissman, who's still with us. But first, let's go to Milan and bring in our South Europe bureau chief, Tommaso Ebhardt, who I know was instrumental to understanding and breaking the story. Tommaso, thank you for joining joining us. So why is, I mean, this is, we're talking about Versace. It's not a natural fit. Why is Prada buying Versace?
Ciao Francine, buongiorno. Is buying Versace just because it's not a natural fit, just because it's the polar opposite in terms of style and design. So Prada considers this a very complementary brand during the fashion cycle. An analyst wrote when minimalist meets maximalist. So the idea is to bring a brand which is completely different than Prada and Miu Miu itself, and also to become bigger, to better compete with a global giant like LVMH and Kering. And remember that Prada's chairman Patrizio Bertelli has always wanted to create a sort of Italian conglomerate to compete with the French rivals. He didn't pay off 25 years ago when he first attempt essentially ended up with a lot of debt, and Prada somehow being helped by Italian banks to survive. Now with his son Lorenzo, it's a new chapter, and this probably is part also of a succession plan in the company.
Tommaso, I mean, Prada intimately also thanks to the book that you've just written on Prada called Prada by Tommaso Ebhardt. But how much of this acquisition is actually a game changer for Prada? I mean, Prada seems to be at the top of the game. It's doing very well in terms of revenue, especially Miu Miu, the sister brand, is like the fashion thing at the moment, whereas Versace probably needs a bit of love.
Could be a game changer. It's also very risky, as you said. You're buying a brand which really needs a revamp, and Prada has already a lot on its plate. But yet, it's also for them an opportunity. It will kept separated in a separate unit. Lorenzo Bertelli, the heir of the family, who had an important role in acquiring Versace, yesterday made clear that his mother Miuccia won't be involved in the creativity of Versace. So for Prada, somehow it's also the moment to get a bigger management team, be more structured, because you have to handle a new important brand. So it's a risky deal, but also gives size and complementarity to Prada.
Tommaso, thank you so much. Tommy Ebhardt there with the very latest on Prada and Versace. This is what everybody should do on a Friday. Learn Italian, read the book on Prada, and get ready for the weekend. Let's also talk now to Andrea Felsted from Bloomberg Opinion and Christian from Goldman Sachs. Andrea, look, you're our retail fashion expert, and there are a lot of questions on whether this makes sense, whether this is a smart play. I mean, this also comes at a really difficult time because of tariffs.
It does. I think this is a terrible idea. I think, Pradashi should have been left in the design room and not seen the light of day. It is incredibly risky. They're talking about a 2 to 4 year time frame. They haven't overpaid for it when you compare the multiple to recent deals, but they haven't got a bargain either when you consider that it will need a lot of investment, it will need an overhaul. All that is going to happen in a really difficult market.
But is there any talk? I mean, do you keep the two brands completely separate? Because you think of Donatella Versace, you think of Gianni Versace, you frankly think of J-Lo in like skimpy dresses. It's very different from Miuccia Prada.
Exactly, and they think this is going to be, as Thomas said, they think this is going to be a key. When you think of the Versace archive, you can mine the archive and really come out with some, iconic pieces. It's also got a lifestyle offering like homewares and hotels. Still, I think this is, very risky. The fact that Miuccia Prada isn't going to be directly involved in the creativity, I think, is actually a worry, not a strength. So, yeah, there's a lot of concerns with this.
It also feels like luxury groups are just getting bigger, right? Because you have Kering and LVMH, and for someone like Burberry, they're struggling because they're on their own. So is it also just a race to get bigger and have more brands? And is that in any shape or form a winning formula?
Well, it has been for LVMH, although even for LVMH, there's talk about, should they spin off some of the divisions. But the thing is, if the bigger you are, the louder you can shout, the more resources you have, the louder you can be to really keep your brands at the top of consumers' minds. And in a difficult time, there does tend to be a flight to those top end. The brands you don't want to take, you're spending a lot of money in a difficult market. You don't want to take a risk on something you don't know. You really want a classic.
And Christian, I guess to the point we were having before is that these tariffs touch industries in different ways, but also it's maybe a little bit too soon to understand because these tariffs are a question mark. Do they get hiked? Do they get taken off? Does it settle? For a lot of industry groups, especially in Europe, it's a bit of a wait and see situation. So it's the strong ones that will do better sector-wise.
Yeah, no, I think you have two problems for sectors right now. You have the cyclical risks, the recession risk we discussed earlier, and you have the profitability risk. If you look in the last few years, the most important style or factor within equities and sectors has been profitability. And now the tariffs, they're starting to weigh on these supply chains, on the whole global trade system, and they introduce these inefficiencies which will weigh on profitability. Luxury goods is a very profitable kind of business. So you got to ask yourself if the tariffs to some extent will change that, and then you have to revisit the equilibrium valuations.
I mean, when you look at your favorite sectors, is tech still in there compared to something, maybe some of the cyclicals that are also more dependent on consumer appetites, be it retail or something else, given inflation could go up?
Yeah, I think, right now it's very difficult. I think we're leaning defensive. We don't think that across assets recession risk is fully priced, which means within the sectors as well, you have to be careful. A lot of repricing has been done. Cyclicals have materially underperformed defensives. Yeah. But we don't think we're at the point where you can sound clear, so we're more defensive. Tech, as you know, has defensive and cyclical tech. So the problem is the defensive tech has potential headwinds from the tariffs, digital service tax, and then there's the cyclical tech, like SAP, very high quality company, but it's exposed to the corporates, exposed to the business cycle. So we are actually much more focused on defense, low volatility type sectors with a bit of value sprinkled in to diversify valuation risk.
I mean, Europe still looks cheap. Is that for good reason, equity-wise, compared, for example, to certain parts in Asia?
Yeah, I mean, China is very cheap. We know that. And if you look compared to history and other markets, that is very cheap. Europe, I think, is a bit in the middle. I think going into this, Europe actually re-rated quite a bit, led by companies that have gotten bigger in the index that are actually very profitable. But again, if you look at valuations, I don't think Europe is cheap. I think in aggregate, you're looking at valuations that are reflecting slightly better profitability and not reflecting a recession yet.
Andrea, going back to luxury, I guess the consumers in China will, if not freeze up, certainly will have a really tough time. Does that impact luxury?
Yes, it does, but the biggest risk is the US. We know China's sluggish, slow rebound. All of the hope at the end of the last year was that the US consumer would come in and pick up the slack until China was spending. We had roaring equity markets, we had a lot of confidence straight after the election. That really seems to have evaporated.
We've talked before about the fact that a lot of these luxury companies have hacked prices by 20 to 30% during COVID. What does it mean for tariffs? Can they still pass on some of these tariff costs, or do they just need to absorb it?
That means it's much harder to push up those prices. If this had been 5 years ago, we would be far less worried because, luxury groups have pricing power, they're expensive items, they're high margin. But those big price increases have really changed the picture.
Okay, thank you both for joining us. Bloomberg opinion columnist Andrea Fausted and Christian Mueller-Glissman, head of asset allocation research at Goldman Sachs. Now, coming up in a week dominated by escalating global trade tensions, where do traders' concerns over cybersecurity risk sit? We speak with the Okta co-founder and chief executive officer, Todd McKinnon. He's coming on next, and this is Bloomberg. Good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, the euro touches a 3-year high as China hits back at the U.S., raising tariffs on imports to 125%. Markets continue their roller coaster ride. The Spanish Prime Minister says China is a partner of the EU as he pushes for a closer relationship during a trip to Beijing. Plus, the UK economy surprises with 0.5% growth in February, the strongest in almost a year. Now, we begin with the latest out of Beijing. China will raise tariffs on all U.S. goods from 84 to 125% with effect from tomorrow. Let's get the details from Bloomberg's Alan Wan in Shanghai. So, Alan, just talk us through exactly what we learned from China. And is this a clear escalation, or is China still trying to retaliate but not going full force?
Yeah, I would say the latter. Overnight, White House clarified that it had increased its tariffs on China to 145%. So, and just now, China said that it's going to increase it to 125, which is 20 points below what the U.S. has been imposing on China. No, I don't necessarily think it's an escalation. And China also said that we're not going to go any higher, which, even though the markets responded negatively, we saw futures start dropping, and I'm sorry, didn't drop, but they paired gains, and the yen strengthened. But I think that some traders were pleased by the fact that China said that it doesn't matter from now on, we're not going to increase it anymore, just because it makes no economic sense. At these levels, people here are not going to be buying many U.S. products.
Okay, Alan, thanks so much. We'll get, of course, stay on top of this story with Alan Wang from Shanghai. Now, EU finance ministers are meeting today in Poland to discuss the latest on tariffs and the European response, as well as finance European defense. Bloomberg's Oliver Crook spoke exclusively to Paschal Donahoe, the Irish finance minister, who said the EU president, Ursula von der Leyen, is calling for a balanced deal between the EU and the US.
So a balanced deal from a process point of view is one that we achieve through negotiation, through using the weeks that now lie ahead to engage centrally with President Trump's administration through the Commission of the European Union. Balanced is one that would involve as much of our economies as possible, and to reach an outcome that takes us away from global trade tension, which for all of us would mean fewer jobs, lower growth and higher prices.
So that was the Irish finance minister speaking to our Ollie Crook. Ollie, so how big is the task ahead?
Yeah, it's an absolutely massive task for European finance ministers that are gathered here in Warsaw, and they really have three things that they need to achieve and they need to figure out in this meeting. The first is the question of negotiation. As we've heard from everybody repeatedly for weeks and months, the European sort of ideal outcome here between the United States is a negotiated outcome. So there's a question about what the Europeans are willing to put on the table. We've talked about a 0% to 0% deal with the United States, but of course Donald Trump is calling for the elimination of non-tariff barriers, which is still an extremely abstract idea, which brings us to the second task for them, which is creating an architecture for retaliation. If they cannot make progress with Donald Trump over these 90 days, the suspension of these tariffs, and there still are 10% tariffs, and they want to bring all of that down. If they cannot, they need to create an architecture in order to respond to the U.S. administration. This could mean taxes on digital companies within the United States that do business in Europe. This could mean higher regulations for those businesses. It could mean higher tariffs, all of those sorts of things. And the third thing, Francine, is evaluation. They need to evaluate what the impact of all of these measures are going to be on the European economy and trying to figure out how to respond to that. Do they need to treat this like a crisis? Do they need to set up crisis measures to support businesses, to support workers? That is the conversation that is happening here in Poland while we await the outcomes from finance ministers who will be meeting over the next 2 days in what we can only describe as really a very chaotic situation, particularly within the markets.
Ollie, does Europe have to choose between Trump and China?
Well, listen, this is an increasing conversation. I mean, as I was interviewing Paschal Donahoe, you had Pedro Sanchez standing alongside Xi Jinping speaking in Beijing, and the Spanish have been, for one, a sort of part of the European Union that have called for a closer relationship with China. When I speak to different finance ministers and different policy officials here in Europe, they are very cautious about making that full pivot. That being said, as the conversation continues, as the pressure increases from the United States, this is inevitably going to be a conversation. Have a listen to what Paschal Donahoe told me, the president of the Eurogroup, so really sort of trying to corral all the finance ministers in terms of what their position is versus China, but also trading with the rest of the world.
It is imperative that the European Union communicates to the US, but also to trading partners all over the world, the fact that we want to be reliable and predictable trading partners. It really is up to President Trump and the US for them to determine how they want to negotiate, what their priorities are. But the EU is a long-term, stable, predictable trading partner.
So, Francine, not a full pivot to China yet, but the Europeans will definitely be looking at striking new deals with other trading partners around the world. We already have the EU talking to the UAE about a free trade agreement, and it's not just in trade. The EU wants to also be a reliable partner for markets. Could the euro take a larger place as a sort of haven currency of the world? That's all ahead with the conversation we're going to have, notably with the German finance minister in a couple hours.
Ollie, thanks so much. Oliver Crook there in Warsaw. Now, businesses around the world have spent the week worrying about supply chains and unpredictable U.S. trade policy. But cybersecurity and the risks from malicious attacks remain a key concern in the corporate world. Now, we're joined by co-founder and chief executive officer of identity and access management company Okta, Todd McKinnon. Todd, so nice to have you on the show again. Now, you're really targeting AI companies as customers. So what's their concern with security right now?
Well, thank you for having me, Francine. It's nice to be here. Companies are thinking about the next platform. So when we think about AI, we talk about AI agents, but really we're talking about how do companies build the next platform for software development. So in the future, all software is going to be AI agents and have an AI component. So we're defining the next platform. So it's like we're building the next iOS or the next Microsoft Windows or the next Linux. And that platform has to have great applications and has to have great capabilities, but it also has to have really robust protection against attacks. And what Okta's doing on that platform is we're trying to bring the identity piece of it. So we released this week something called Auth for Gen AI. So these companies that are building these applications, these AI agents, can have great identity and secure identity and identity that can connect to multiple systems and identity that can broker the connection between agents and people and have that done in a secure way and have the outcomes that they want to accomplish.
So, Todd, I mean, does 80% of the world actually, I guess, not understand how difficult this is, given AI, where you can fake personalities or even, fake maybe facial recognition longer down the road? Are people taking this seriously enough? At the end of the day, I mean, this is why your company is worth $15 billion, because some people are taking it very seriously, but is the wider public aware of the dangers?
Well, I think what's becoming more and more apparent to everyone is that cybersecurity is important, and as part of that, identity management is at the core of that. Whether it used to be about network firewalls and what you did on your personal computer to be secure. Now, for a company to be secure, they have to manage their identity. So they have to know who the people are in their organization, who their business partners are, who their customers are, who their employees are, have a system to securely identify them in a robust way. And that all translate to this new software development platform of AI agents. The same things apply. You have to know who are the people, who are the agents. You have to be able to broker the connections between the two. And that's going to unlock the value of this new AI revolution.
How quickly will we have such a platform?
Well, there's pieces of it already today, and you're seeing companies like Salesforce launch their version of the platform. Google had a bunch of announcements around their version of the platform this week, and we're doing our part with Auth for Gen AI. So as an industry, we're busy building it, and we're trying to deliver value to customers today, and at the same time balance the long-term risks to make sure the platform is used in the most positive ways and we avoid all the cyber issues that are possible.
Todd, what are you most excited about when it comes to AI? Because I know you've pushed back, for example, about this, belief amongst many that you'll lose jobs because of AI, or certainly there'll be such a huge disruption in the jobs that humans will do because of AI.
I believe that there's going to be some change and some transition, but I think a lot of the industries where AI is being used the most heavily, I think the talk about losing jobs is a little bit overdone. Mm-hmm. Take software development, for example, something I know a lot about growing up as a software engineer, and people talk about how AI is going to replace software developers. I think that's very overblown. I think what you're going to see as every generation of technology, from computers to PCs to mobile phones, the software development tools got better. And that's no exception today. The software development tools are getting much, much better. But what that's done is it hasn't resulted in fewer software engineers. It's resulted in the software engineers working on bigger problems and more important problems and letting the machines do some of the low-level heavy lifting that wasn't really required of a human. So I think you'll see that in a lot of industries. AI will help, and the people will do other tasks that are more valuable.
How much do you want to grow Okta by in terms of revenue, or just is there acquisitions on the table, or will it all be organic?
We're excited about the future. We think the market we're playing in is an $80 billion market, and our turnover last year, US dollars, was $2.6 billion. So we have a lot of room to grow. And the good news is that our core market is quite large and robust. And then also it gives us a good opportunity to look to adjacent markets as we try to solve these problems for our customers.
So, John, after basically launching these new tools to secure AI and digital identities, what's next in what you're trying to develop? And again, how quickly will it be accessible?
Yeah, our strategy is we want to have the leading product in every subcategory of identity. So we've launched over the last couple of years products in things like privileged access management or identity threat protection or identity security posture management, customer identity. So it's really, we want to continue our lead. We're by far the largest independent and neutral identity company. We want to extend our lead by having the widest breadth of identity products in the industry, but also have the deepest integrations. Identity systems are only as valuable as how connected they are to everything in your ecosystem, so that's our strategy.
Todd, thank you so much. That was a great conversation that I hope will continue, because this is something that a lot of people, and we have viewers writing in, want to know more about. Okta co-founder and chief executive officer there, Todd McKinnon. Now, Donald Trump's flip-flopping on tariffs has sparked major swings across markets, from losses in U.S. stocks to routes in debt, FX, and commodities. Dalio, founder of Bridgewater Associates, is warning that investors are too focused on tariffs and not paying enough attention to the breakdown of major monetary, political, and geopolitical orders.
There has to be a recognition that we have a structural problem in that we have an interdependency that the United States can't, either financially or geopolitically because of the risks, be in a position where it's dependent on getting stuff from China. And similarly, for the Chinese, they can't feel safe about getting their capital returns in that way. So in a global economy, you can't have, by definition, large imbalances. So now the question is how to deal with that. That's an engineering exercise. In my opinion, they can have a negotiated way in which the currency is raised. They have to, in one way or another, deal with this, reduce that. So the currency can be raised, the RMB, which would happen by then starting to sell off reserves. The United States likes the fact that the currency would appreciate, and that probably the Chinese like the fact that they can get less in debt by selling off some of their holdings in that dynamic to support the currency, in which case then China has to not just be a manufacturer, but it has to be a consumer. And right now, about 33% of all manufacturing in the world, which is more than the United States, Germany, and Japan combined, is from China. So they manufacture. The United States does not manufacture that, and so what the world needs now is the Chinese to be consumers. So if you would have that foreign exchange increase, and you were to deal with trade together in a sensible way, I think, ideally, then you would also have, naturally, Chinese doing an increase in monetary and fiscal policies to raise demand, particularly consumption, because exports are going to go down, manufacturing is going to be a problem, so that if they raise consumption and the United States becomes less consumption-driven and more production-driven, at least those are movements in the right direction. Such negotiations, unfortunately, and such actual big changes are unlikely to take place quickly enough and well enough, is my fear.
Mm-hmm. But, right, I mean, given that, and given this possible permanent scarring of U.S. dollar and treasuries, is a U.S. recession actually avoidable?
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero. You get and sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about let's say 2 quarters of stagnation or a little bit of negative? I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
Ray Dalio there, the founder of Bridgewater Associates. Coming up, banks kick off earnings season with JP Morgan, Morgan Stanley, and Wells Fargo reporting today. So we'll have a full preview. That's next, and this is Bloomberg. Welcome back, everyone. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, JP Morgan, Morgan Stanley kick off earnings season today as banks and other major companies struggle to navigate Donald Trump's trade war. Now, Bloomberg's Charlie Wells is here with the very latest. Charlie, good morning. I mean, everyone's struggling, A, to understand, 2, to actually count some of their losses. Now, on the banking side, will analysts be paying attention to anything than the forward guidance?
Francine, I mean, that just kind of hits the nail on the head, right? This is all about the future, and that's going to be really frustrating for particularly traders who actually had a pretty darn good quarter, right? It's looking like record revenue for some traders, Morgan Stanley, JP Morgan as well, really having some strong equities trading there. But there's a really interesting question here about equities trading and just trading in general. There's been a lot of volatility. Have we reached peak trading, right? Because if there's too much volatility in these markets and it's looking like the volatility will continue, participants start sitting on the sidelines. So that's kind of looking back. But yes, the question is, how do these banks even project forward what's going to happen in the year ahead?
Yes, so bigger picture, how are banks and other large firms really navigating, again, earnings amid so much uncertainty and so much market volatility?
Yeah, I mean, I feel really bad for the junior analysts at these firms who have to come up with these slide decks and these investor presentations and these earnings calls because they've been ripped up time and again as policy changes. And I think, one of the dilemmas that CEOs face right now is, do they give a lot of information and then have to worry about being wrong or having to backtrack, or do they give too little and then analysts who have to come up with their assumptions anyways, do those analysts come up with some kind of estimation that's not right? So I think there's this real difficult balancing act that they face, and it's the subject of our big take today.
Charlie, thanks so much. Charlie Wells there with the very latest, of course, on some of the banking report. I mean, it's kind of, flat. I mean, usually the JP Morgan report is like 110 pages and we have to go through it. And even more with the added volatility, it's going to be an incredible couple of hours. Now, let's continue our coverage on how the banking sector is interpreting the impact of Trump's tariffs. Our Bloomberg opinion columnist, Paul Davies, joins us now. So Paul focuses on banking. And Paul, you've written good morning, first of all, but you've written some great columns kind of, encapsulating why some of the financial stocks have been under pressure, as much or not more than a lot of the other industries. So your first column, when all this turmoil started, really hit for me the nail on the head. It's basically Trump's trade war looks brutal for finance too. So this is my morning must read. I know you've done a couple of other ones afterwards, but it basically has all the ugly sides all condensed if you're a bank, because you have loans you have to deal with, you have consumers, you have retail banks.
Yeah, exactly. So, I mean, the problem here is the stagflationary outcome, is the high inflation or, persistent inflation and low growth. And what do you do then? It's, either rates stay high and you end up with a lot more credit problems, a lot more bad loans, or rates are cut and you probably still get bad loans, but you also get lower, interest income. And at the same time, I mean, as Charlie was saying, there's been some great equities trading in the first quarter, but that might well fade from now on because, there's so much uncertainty about exactly what to do. People have got into more defensive positions and they'll probably stay there. And on the investment banking, the fees side, everything is just on hold until there's some certainty. So we've already seen, StubHub, Klarna, eToro pause, IPOs that were due to come basically about now. Nobody is going to take the dust sheets off those things until you get, much more certainty about where markets are going.
But Paul, who do you think, first of all, suffers the most? Again, I know, apart from the companies that can't IPO right now, there must be banks or especially especially vulnerable. Even, given there was a point where the market was so distressed that we kind of thought whether some investors would even go under. We hadn't seen any of that, but that was one of the questions that people were asking.
Yeah, and I mean, the thing that really turned, White House policy this week was the sell-off in the bond markets. And if that, I was talking to lots of people yesterday involved in kind of funding and repo financing and so on, and the message was, well, everything was functional, it was strained, but it was functional. There weren't like real problems yet, but if they hadn't have, if Trump hadn't have pulled back on some of those tariffs and that trading had continued, then you would have seen much bigger funding strains and real problems in the shadow banking, the hedge fund sector, and possibly the Fed having to step in and do something in terms of supporting Treasury markets. Yeah,
so what are you looking out for in the earnings today? Again, this is partly like, consumers will be slammed because of lower growth and higher inflation. Yeah. If you're a commercial borrower right now, you're also probably looking at your books. Yeah. I mean, there's like a lot of, in terms of, just like capital markets, in terms of investment spending, in terms of order books, people are just kind of going to be sitting on their hands a bit and not doing, so much business. I mean, it was interesting. Jamie Dimon was on TV on Wednesday and talking about how he saw recession as a likely outcome under those, global tariffs as they were. So we'll be listening today to hear if he changes his tune on that. I mean, we still have, blanket 10% tariffs across the world, 25% on cars, whatever the number is on China now, it's still not a great world to be in. So does he still think we're looking at recession, or has his view kind of eased off a bit? Look, investment bank was meant to be, 2025 was meant to be the big year of revival for the investment bankers. Are we going to see job losses? I mean, if this carries on as it is, then almost certainly. The first quarter has already disappointed in terms of, M&A, IPOs, and that sort of thing. We had a great finish to 2024. Everybody thought that, a pro-growth, deregulatory, Trump administration was going to just, set fire to all of this stuff, and we'd have a great boom. First quarter was already disappointed because there was so much uncertainty. That uncertainty's only grown, and its second quarter is going to be really disappointing unless something changes, and then on into the rest of the year. Paul, I'm going to go rogue because I do quite like you did a couple of explainers on Instagram on things that were quite nerdy, like the spirals and some of the carry trades. Also, I think in some of the bonds. Like, what did you live through in the last 7 days? Like, is there anything in the financial system plumbing that we should be looking out for compared to past crises? I mean, again, I'd go back to the Treasury bond market and the financing and the hedge fund world. This week has been, you've seen some kind of, quite wild sell-offs or wild-looking sell-offs in treasuries, but it has been relatively orderly. We haven't seen, prices really gapping. We haven't seen people struggling to kind of like get orders filled, and it's when that sort of thing starts to happen, that's when you're really into like proper crisis mode. Yeah, on the hedge funds, and I had a conversation yesterday with Ray Dalio about maybe, some of the proposals by the Brookings Institute to curtail some of the hedge funds if these market dislocations are much more violent. Is anyone going to look at more regulation because of what happened this week and last week? I mean, my personal view is that ultimately they have to, and that's because this whole complex of very, very large hedge funds is now so important, not just to the financial system, but to the financing of the broader economy. I wrote a long piece about all of this this week as well. And I think ultimately, a simple leverage ratio where you just cap how much money they can borrow is too simplistic and too crude. It's like a leverage ratio for banks. So what you need is that combined with a more risk-sensitive leverage ratio and some measures of how much liquidity they have to hand to defend themselves against waves of margin calls and that sort of thing. Okay, thank you so much, Bloomberg opinion columnist there, Paul Davies. Now, don't miss our exclusive interview with the Swiss President and Finance Minister, Karin Keller-Sutter. That's at 11:45 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.